1. A silent shift in inflation data is raising red flags. A silent shift in inflation data is unsettling policymakers because it's not showing up as a dramatic spike, but as a subtle change in where and how prices are rising. Headline inflation may appear to be cooling, yet underlying components like services, housing, insurance, and healthcare remain stubbornly high. Even more concerning, short-term inflation measures are easing while long-term expectations are beginning to edge upward, signaling that people may be losing confidence in price stability. At the same time, inflation is becoming less driven by supply chain shocks and more by structural pressures such as wages, government spending, and persistent demand in certain sectors. This kind of inflation is harder to fight with interest rates alone. For the Federal Reserve, the danger lies in misreading the data. Cutting rates too early could reignite inflation, while staying too tight for too long could choke economic growth. It's this quiet but meaningful shift beneath the surface that's raising red flags, forcing the Fed to move more cautiously than markets might expect. 2. Consumer spending is slowing faster than expected. Consumer spending is slowing faster than expected, and this is flashing an early warning sign for the broader economy. After months of resilience, households are beginning to pull back as higher interest rates, rising living costs, and shrinking savings take their toll. Credit card balances are climbing, delinquencies are ticking up, and more consumers are prioritizing essentials over discretionary purchases. This shift suggests that spending strength was less sustainable than it appeared on the surface. What worries policymakers is the speed of this slowdown. Retail sales, travel, and big-ticket purchases are losing momentum almost simultaneously, indicating pressure across income levels. Since consumer spending drives a large share of economic growth, a sharper-than-expected pullback could quickly translate into slower hiring and weaker business investment. For the Federal Reserve, this creates a delicate balancing act: support growth without reigniting inflation, at a time when consumer confidence is clearly beginning to crack. 3. Job market cracks are becoming harder to ignore as the strength seen in headline employment numbers starts to fade beneath the surface. While unemployment rates may still look healthy, other indicators tell a more fragile story. Hiring is slowing, job openings are declining, and companies are becoming cautious about expanding payrolls. Temporary jobs and gig work, often early signals of labor market stress, are cooling, suggesting employers are preparing for softer demand ahead. More concerning is the shift in worker behavior. Layoffs are rising quietly in specific sectors, wage growth is losing momentum, and fewer workers feel confident enough to switch jobs. This reduces bargaining power and signals that the labor market is no longer as tight as it once was. For the Federal Reserve, these cracks matter deeply. A weakening job market can quickly drag down consumer spending and overall economic confidence, increasing the risk that economic slowdown turns into something more severe if policy remains too restrictive. 5. Financial markets are sending conflicting signals, leaving everyday Americans caught between hope and anxiety. On one hand, stock markets continue to show strength, suggesting confidence in future growth and corporate profits. On the other hand, bond markets are flashing caution, with yields and yield curve movements hinting at slower growth or even recession risks ahead. For many people watching their retirement accounts, this mixed message is confusing and emotionally exhausting. What makes this moment especially touchy is how disconnected markets feel from real life. Wall Street optimism contrasts sharply with Main Street pressure, where families are dealing with high living costs, expensive loans, and job uncertainty. Markets may celebrate the idea of future rate cuts, but households are still paying today's high interest rates. This gap creates a sense that the economy is doing well on paper, while personal finances tell a different story. For the Federal Reserve, these mixed signals complicate every decision. Markets react instantly to policy hints, sometimes moving ahead of reality, while data lags behind real human experience. If the Fed follows market optimism too closely, it risks ignoring the financial stress building in households. If it leans too heavily on caution, it could tighten conditions unnecessarily. In the middle of all this are ordinary Americans trying to make sense of headlines while planning their futures. When markets disagree with each other, uncertainty grows, and uncertainty is often the hardest economic burden to carry. 6. Global economic stress is feeding back into the U.S. in ways that are subtle, complex, and increasingly hard to escape. For years, Americans were told that the U.S. economy could remain strong even if the rest of the world slowed down. But in a deeply connected global system, trouble abroad rarely stays contained. Weak growth in Europe, financial strain in emerging markets, and ongoing instability in major economies like China are now looping back into American businesses, jobs, and prices. One major channel is trade. When global demand weakens, U.S. exporters feel it first. American manufacturers, farmers, and tech companies sell less overseas, cutting into revenues and slowing hiring at home. At the same time, foreign companies under pressure reduce investment in the U.S., which means fewer factories, fewer partnerships, and long-term growth opportunities.
Even companies that operate mostly inside the U.S. are affected through supply chains, as disruptions or rising costs abroad ripple through domestic production. Financial markets amplify this stress. Global uncertainty drives volatile capital flows, sudden shifts in currency values, and sharp market reactions that affect American stocks, bonds, and borrowing costs. When investors rush into safe assets, it can tighten financial conditions unexpectedly. U.S. banks, corporations, and pension funds all have exposure to global markets, meaning losses or instability overseas can quietly weaken balance sheets at home without showing up immediately in headlines. There's also a human cost that often goes unnoticed. Global inflation pressures, whether from energy shocks, geopolitical conflicts, or supply shortages, hit American households through higher prices and reduced purchasing power. Meanwhile, slowing global growth limits the Fed's ability to rely on external stability while managing domestic inflation. The central bank must now weigh U.S. conditions against a fragile global backdrop, knowing that policy moves here can worsen stress abroad, and that stress will eventually come back. In the end, global economic strain acts like a slow tide rather than a sudden wave. It doesn't crash all at once, but it steadily reshapes the shoreline of the U.S. economy. Jobs become less secure, markets grow more sensitive, and policy choices become riskier. This feedback loop is what makes the current moment so delicate. America is no longer just reacting to its own economy, it is absorbing the weight of a world under pressure. 7. Rate cuts now risk reigniting inflation. Rate cuts now risk reigniting inflation because the forces driving today's price pressures are very different from those of the past and far more stubborn. Inflation is no longer just the result of temporary supply shocks or pandemic disruptions. Instead, it is increasingly embedded in structural areas of the economy, such as housing, services, wages, and government spending. Cutting interest rates too soon in this environment could pour fuel back onto a fire that hasn't fully gone out. At the heart of the problem is demand. Higher interest rates have slowed parts of the economy, but they haven't crushed consumer demand entirely. Many households are still spending, supported by wage gains and credit. If borrowing costs fall, demand could rebound quickly, especially in housing and services, before supply has had time to adjust. This imbalance would push prices higher again, undoing the progress made so far, and forcing the Federal Reserve into an even more aggressive response later. Another major risk lies in inflation expectations. Inflation isn't only driven by numbers, it's driven by belief. If businesses and consumers begin to think the Fed is backing off too early, they may assume higher inflation is here to stay. Businesses raise prices preemptively, workers demand higher wages, and a self-reinforcing cycle begins. Once expectations become unanchored, inflation becomes much harder and more painful to control. Financial markets add another layer of danger. Even the hint of rate cuts can loosen financial conditions. As stock prices rise, credit becomes easier, and risk-taking increases. This can stimulate economic activity long before an actual cut occurs. In effect, markets can front-run the Fed, neutralizing its efforts to keep inflation under control. When financial conditions loosen too fast, inflation can quietly rebuild momentum under the surface.
For the Federal Reserve, this creates a narrow and uncomfortable path. Cutting rates too late risks economic damage, job losses, and financial stress. Cutting too early risks repeating the mistakes of the past, where inflation resurged and required harsher tightening later on. This is why policymakers remain cautious, despite political pressure and market expectations. The lesson is clear. Inflation doesn't need a dramatic comeback to be dangerous. Sometimes it only needs a small policy mistake at the wrong moment to return stronger than before. The Fed's soft landing path is narrowing fast, and that reality is becoming harder for both policymakers and the public to ignore. A soft landing means slowing inflation without triggering a recession or major job losses. For a while, that outcome seemed possible. Inflation cooled, the job market stayed strong, and the economy kept moving forward. But as time passes, the margin for error is shrinking, and every new data point makes the balancing act more fragile. The core challenge is timing. Monetary policy works with long and uneven delays. The interest rate hikes already in place are still working their way through the economy, hitting households and businesses months after decisions are made. If the Fed waits too long to ease, those delayed effects could tip the economy into a downturn. If it moves too soon, inflation, especially in services and housing, could reaccelerate. There is less room than ever to get the timing exactly right. What makes this moment emotionally resonant for many Americans is how uneven the experience feels. Some parts of the economy still look strong, while others are clearly under stress. Families are juggling high rent, expensive groceries, and rising debt. Small businesses are facing tighter credit and slower demand. Workers feel less confident about changing jobs, even if they're still employed. These mixed signals make it difficult for the Fed to rely on traditional indicators alone, because lived experience is diverging from headline data. External pressures are also tightening the path. Global economic weakness, geopolitical tensions, and heavy government debt all limit the Fed's flexibility. Any policy